You know, when you get life insurance, the whole point is pretty simple, right? It's to protect your family. But there's always this nagging question we hear from folks all over Georgia. Is that protection going to come with a surprise tax bill for the people you love most?
All right, let's just get right into it. This is a huge question, especially when you're thinking about retirement and what you're leaving behind. I mean, the absolute last thing you want is for your family to get hit with a tax bill when they're already going through so much. So, in this explainer, we're going to clear this up for you, once and for all.
So let's kick things off with the general rule. And hey, this is the good news pretty much everyone is hoping for. And yeah, that good news is, for most situations, the answer is a simple, straightforward no. That's right, your life insurance payout is typically not taxable. So here's the key takeaway. When your beneficiaries get that payout all at once in a single lump sum, it's almost always free from federal income tax. And what's even better for us here in Georgia, the same thing goes for our state income tax. No tax there either. You can imagine that's a massive relief for so many families.
Okay, but you know how it is with finances, right? There are always a few buts and exceptions to the rule. And it's really, really important to know what these are so your policy actually does what you want it to do.
So what are these tricky situations where taxes could pop up? Let's break down the three main scenarios you've got to keep an eye on. They basically fall into three buckets. First, any interest that the payout might earn. Second, estate taxes, but that's only if you have a really large estate. And third, there are some specific rules around life insurance you get from your job.
Let's tackle that first one, interest. So imagine your beneficiary decides not to take the money all at once. Instead, they get it in installments. Well, while the insurance company is holding on to that cash, it's earning interest. And that interest, that's considered taxable income. Now, to be clear, the original death benefit amount is still totally tax-free. It's just the extra money earns, the growth, that gets taxed.
All right, next up is the big one, estate tax. Now, let me just say, this really only comes into play for very, very large estates. The federal exemption amount is huge. We're talking just shy of $14 million for 2025. So if the total value of everything you own, including that life insurance payout, goes over that massive number, then yeah, the payout could get hit with estate taxes. But here's some more good news for us Georgians. We don't have a separate state estate tax to deal with. That's a big plus.
And that brings us to the third situation, which has to do with life insurance you get through work. A lot of employers offer it, which is great. But if they provide you with more than $50,000 worth of coverage, the cost of the premium for everything above that 50 grand mark is actually considered taxable income for you. Just something to be aware of on your W-2. Okay, so that's the death benefit covered. But I bet you're wondering about the other parts of a policy, right? Like, what about the premiums you pay in, or the cash value that some policies build up over time?
We get this one all the time. Can I deduct my life insurance premiums on my taxes? And look, for almost everyone with a personal policy, the answer is going to be a clear no. The IRS just sees it as a personal expense, kind of like your car insurance, so you can't deduct it. Now, if you have a permanent policy like a whole life or universal life policy, you've got this cool feature called cash value. And there are basically two ways you can get your hands on that money. The first is a withdrawal. You can pull out up to the amount you've paid in premiums over the years, and that's completely tax-free. It's your money back. But if you withdraw any of the gains, anything above what you paid in, that part is taxable. The other option is a policy loan. Taking a loan against your cash value is usually not a taxable event at all, as long as you keep the policy going. So with all these rules and exceptions floating around, how do you actually build a strategy to make sure your life insurance is as tax-friendly as possible? Well, it really all boils down to one thing: planning ahead. And honestly, this is where getting some professional guidance can be a total game changer. An expert can help you weave through all these rules, protect the people you care about, and slash any potential tax hits. They'll help you build a plan that's tailored specifically for you, right here in Georgia. You know, a good process here is usually pretty simple. Step one is just taking a good hard look at the policy you already have. From there, you can work on developing a really tax-smart strategy. Sometimes it's as simple as changing who owns the policy or using something called a trust. And finally, and this is crucial, you've got to put the plan into action and then keep an eye on it. Because let's face it, life changes and your plan needs to be able to change right along with it. Getting these details right is absolutely key to protecting your legacy. If any of this has you scratching your head, talking it over with a trusted local planner can bring so much clarity and, honestly, peace of mind. And just remember, It's never, ever too early to start planning for your family's future. So I'll just leave you with this one question to chew on. After hearing all of this, are you absolutely sure that your life insurance policy is set up to protect your family in the most tax-efficient way possible? It's a really important question, and it's definitely worth knowing the answer.